Let's talk about the rules of money in India. Because right now, the entire system, how we borrow, how banks lend, it's all going through a massive overhaul. And believe me, this isn't just some abstract financial news. This matters to all of us because a stable financial system, well, that's what keeps the whole economy humming.
So, let me ask you a question. What on earth could a gold loan, where you pledge jewelry for cash, have in common with a super complex partnership between a huge bank and another financial company? They seem like they're from totally different worlds, right? Well, the surprising answer is they are both smack in the middle of a huge regulatory shakeup. And this is no accident. There's a single powerful reason why both of these are getting so much attention at the exact same time. And the architect of all of this is the Reserve Bank of India. They're stepping in to get ahead of a huge invisible threat, one that secretly connects pretty much everything in the financial world.
To really get why these new rules are so critical, we first have to understand the monster the RBI is trying to tame. It's a concept called systemic risk, and it's all about those hidden connections we just mentioned. So let's start with a really simple question. We think of banks as these separate pillars, competing with each other. But what actually happens when, say, 3 or 4 different banks are all lending money to the very same company? They form an invisible web, just like what you're seeing here. The circles are the banks, the squares are the borrowers. See how those borrowers in the middle become bridges? They end up connecting lenders who might not even realize how closely their fates are now tied together. And that brings us to the big, scary term, systemic risk. All it really means is the danger that one failure doesn't stay in its own lane. It's the ultimate domino effect, the risk that one bank's problem could set off a chain reaction that threatens to bring the whole system down. So, here's the bottom line. That web of common borrowers we just saw, it's the perfect highway for risk to travel. If one of those big borrowers goes under, it doesn't just hurt one bank. Oh no, it sends a shock wave through that entire network. And that is exactly what the RBI is trying to prevent. Okay, so now that we get the problem, this hidden network of risk, let's look at what the RBI is actually doing about it. First up, we're going to zoom in on co-lending, where the RBI is basically laying down some new rules for playing on the same team. First, what even is a co-lending arrangement? Well, simply put, it's when a traditional bank teams up with a non-banking financial company, an NBFC, to fund a loan together. It's supposed to be the best of both worlds, the bank's money and the NBFC's street-level reach. And here's rule number 1, and it's a big one. It's all about having skin in the game. From 2026, every partner in a co-lending deal has to keep at least 10% of that loan on their own balance sheet. No more passing off all the risk. Everyone has to have a real stake in making sure that loan gets paid back. Now, rule number 2 gets a little technical, but it's super important. It caps something called a default loss guarantee at just 5%. Think of this guarantee as a secret insurance policy, where one partner tells the other, hey, don't worry, if this goes bad, I'll cover the losses. This new cap stops that, forcing the risk to be shared for real, out in the open. And there's more. The new rules demand a whole new level of discipline and transparency. Basically, if one partner admits a loan is in trouble, the other has to as well. No more pretending everything is fine. And borrowers have to be told upfront exactly who they're dealing with. So what's the big idea here? Well, the RBI isn't trying to kill these partnerships. Not at all. The goal is to let them flourish, to get more credit flowing into the economy, but to do it with some serious guardrails that make sure everyone is acting responsibly. All right, let's pivot to our second case study, the gold loan market. Now, this is a totally different kind of risk. This isn't about hidden connections between lenders. This is about way too much risk getting piled up in one single market that's been getting hotter and hotter. And here's the core of the problem. Gold prices have been going through the roof. That's encouraged a ton of people to take out loans against their gold. But, and it's a big but, that boom has brought a pretty scary rise in the number of people who can't pay those loans back. And hey, don't just take my word for it. The data on this chart is crystal clear. We're looking at a huge jump in non-performing assets. That's just a fancy term for loans that are going bad. For banks, it's shot up by over 600 crore rupees in just 1 year. For the finance companies, it's even worse. This is a flashing red light. So, what's the RBI's plan to cool things down? They're bringing in a new tiered system for something called the loan-to-value ratio. It's pretty simple. The amount you can borrow now depends on the loan size. For smaller loans, you can borrow up to 85% of your gold's value. But for those bigger loans, over 5 lakh, that drops to 75%. This forces a bigger safety cushion for lenders. And what I really like is that these rules also bring in some serious protections for borrowers. Your gold has to be returned within 7 days after you pay off the loan. The way they value your gold has to be transparent and fair. And maybe most importantly, the loan agreement has to be in a language you actually understand. Okay, so we've looked at co-lending partnerships, and we've looked at the gold loan market. Now it's time to zoom back out and connect the dots. How do these two completely different sets of rules tell one single story? Well, it really just boils down to this. You've got two different problems, but one unified goal. On one side, you have lenders getting too tangled up with each other. The solution? Rules like skin in the game. On the other side, you have too much risk getting concentrated in one hot market. The solution there? Things like tiered lending limits to pump the brakes. And this right here is the perfect visual summary of the RBI's two-pronged attack. On one hand, they're managing that messy and visible web of connections. On the other, they're managing the very visible, very real risk of a market bubble. Both are absolutely crucial for a healthy financial system. And you know, Ram Rostagi, a major industry leader, put it perfectly. He said this isn't about killing growth. It's about making sure that growth goes hand in hand with responsible risk sharing. It's all about building a system that's stable enough to last. Which leaves us with the big final question, doesn't it? For a country growing as fast as India, how do you find that perfect balance? How do you keep the money flowing to fuel growth while also building up the defenses you need to stop the next financial crisis before it even starts? That's the tightrope the RBI is walking right now.